Yes. So we have seen, incremental capital output ratio in detail. So now that our detour is over, now we'll be getting back to expenditure method of GDP calculation again. Okay. So we have already covered the following parameters, consumption, investment. Obviously, the third parameter will be your government expenditure. From the circular flow of income, sir, we already know where the government expenditure comes from. So essentially there will be a tax, and based on the tax the government will do expenditure spending. So essentially government collects the money and spend, like it can be on infrastructure project, it can be for welfare of people, like insurance scheme like Ayushman Bharat, etc. It can be on wage employment like Manrega, etc. So this is essentially government spending, it's essentially government spending for various objectives. So that is called as government expenditure, and that is also a part of GDP, sir. But that is not important here, like that is also important, but the thing is role, we need to have a objective, like we need to have understanding about the role of government expenditure, sir. What should it be? So essentially the government expenditure should be something like counter cyclical, sir. So what is the meaning of counter cyclical? That is what we look at. Okay, so essentially if you look at GDP growth rate will not be like linear path like this. It will not be a straight line, rather it will be going through a cycle. Suddenly we will have a peak, suddenly then we will have a downfall. So this downfall can be like COVID, then we will again now have a peak, similarly next crisis will come, downfall. So similarly, and like this it will go. This line represents the overall trend line, sir. If you take an average overall, if you look, it will traverse on that line. So this up and down is called as business cycle, sir. So what does government expenditure should aim to do? Government expenditure should aim to smoothen the business cycle. Smoothen means, what is the meaning, sir? Let's understand. See, suppose we are going through a crisis. So that means my GDP is decreasing, sir. It can be a recession or a depression. My GDP is decreasing. What will government do? So we already saw these are the three parameters. So government on its behalf, what will it do? It will increase the government expenditure, sir. It will increase the government expenditure to counteract the decrease in this. Like generally if there is a crisis means your consumption and investment will decrease. So essentially government will do what? To compensate for that, it will increase the government expenditure, sir. So essentially by increasing the government expenditure, we can reduce the impact of the depression or recession, sir, and we can bring back to the growth rate. So this is first part of it. Similarly, when I'm going to this peak, generally if there is no government action, we will immediately come to downfall. Okay, this peak will be shorter period. The government will, what will government do? Government will take in some policies to prolong this peak. So that means what kind of policies government should take? See, I want the cycle to be extended. That means here government will not spend more, rather government will collect more. See, government will increase the taxes, sir. Essentially government will increase the taxes, so that means it will collect the money from the people, reduce the demand, so that the GDP increase is very gradual, not very upright. So what is the benefit of this? So for a longer period I am having a positive growth cycle. Similarly, through this government expenditure, I am also reducing the impact and period of the negative growth cycle. So that is what is the role of the government expenditure. By doing this, essentially by increasing government expenditure, I will be increasing my GDP. We have already seen how GDP increase is correlated to, that is growth rate. GDP increase means growth rate and employment increase, sir. So essentially through government policies, by increasing the GDP, we all directly increase the growth rate of the GDP and employment. This we have already explained in the virtuous cycle. Okay, so the next parameter will be exports. So exports, we already know what is export. Simply, the production will be happening in India, but the consumption will be happening outside India. So that is called as exports. So I have already thrown a seed saying that, India is a consumption-oriented economy, China is an export-oriented economy. So you already got a feel. So I said I'll explain it over here. So, what is the importance of export? So that we can get from China. Essentially, if I am only dependent on consumption for my growth, okay, what will happen? So after some time my population will decline, etc. Then my consumption will decline, sir. Okay, but when I'm export oriented, that means I'm large amount of my GDP is consumed by rest of the world. That means the rest of the world, I cannot guarantee that population is going to decrease. So eventually my GDP will be increasing for a longer period. So that is why, in fact, even our India's objective is to have more exports, sir. So it want to have a export oriented economy. So one of the objective is to have a prolonged growth. Apart from that, exports also give us foreign exchange. So essentially, when you are exporting more, you will get more foreign currency, which can be used for buying imports. Essentially, India's rupee, you cannot use India's rupee to buy imports. You need dollar. So for that, you need to export. All this will be in detail explained external, but just to get a feel for it over here. Okay. So similarly, what is the other reasons for government to promote the export apart from having longer growth period? One will be competitiveness, sir. What do we mean by competitiveness? That means if I can develop my industry to international standard, only then my exports will grow. So that means essentially by focusing on export oriented industries, we are developing their competitiveness. That is, we are developing their efficiency, sir, to give goods quality products at affordable prices. So apart from that, we already saw one of the parameter, virtuous cycle, which was explained by economic survey. I've already done that over there, so we'll not be repeating it again. So that is with respect to export. Similarly, we will also look at import, sir. So import, it is the opposite of export. Essentially, what produced outside, consumed by India. Okay, so that is import. And government, so like how government is trying to promote export, government definitely wants to reduce import. However, it cannot be made to zero, sir. Why? Because there are certain essential commodities which we don't have. We have to import, for example, oil. That and all we cannot produce. Unless until the world goes electric and all the industrial process, we can hope for an entire renewable change. So even then also there's a lot of ifs and buts you can see. So essentially there are essential commodities we can, but imports can be reduced, sir. Reduced through what? Indigenization. So essentially whatever which is being produced in the outside country, like if we start producing, we can reduce the imports. A classic example recently would be mobile phones. India is now the second largest manufacturer of mobile phones. Earlier we used to import all the mobile phones from China. So now we have started setting up manufacturing base and started assembling mobile phones in India. Okay, so that is one of the important aspect. And in line with that, I would also like to say one more thing. So basically, to increase the exports, also the one of the major strategy which is suggested by your economic survey. So they have suggested a strategy that is to increase the export, don't build the product entirely, rather focus on integrated into global value chain. So strategy is for increasing export is to integrate into global value chain. What does one mean by global value chain, sir? So simply let's take an example of this pen. So in a global value chain, I will not be producing the entire pen, sir. The front part will be produced by one country, the second part will be produced by one country, the middle part will be produced by one country, and assembly will be done in one country. Okay. So what is the advantage of this? Maybe the raw materials needed for front parts are available in first country. That is why first country is producing. Similarly for the other countries also. And why assembly is happening in one country? Assembly needs a lot of labor. So generally it will be happening in a developing country. Previously China was doing. Now there is a base shifting from China to Vietnam and also partially to India. So that is why what the policy makers are saying, if you want to have an export oriented path, rather than taking this long route of replicating all the industrial complexes, set up assembly line, like assemble India policy, that is integrate with global value chain. Okay, so this is one other strategy. This is just a mains perspective, but I just wanted you to understand what is global value chain. Often the terms comes in newspaper. Now this is an activity. Okay, so now essentially we have completed the expenditure method. All I want you to do is basically identify among all this which of is an export and which of is it an import. This is more like prelims application. Prelims, there can be question like this which will test your logic. So I want you to do this part. Pause the video, take 5 seconds or 10 seconds, 5 minutes also. Do it and then come back to solution. Okay, now I'm going to say the answers. So first thing, see, there is a company in India. Okay, Okay, it is sending goods to foreign country, whether it's import or export. Obviously, it is sending goods. Goods are going outside, produced in India. Obviously, it is export, sir. Not a big thing. Classic example. There's a company in India, okay, X company. They are producing services, sir. They are sending that services where? To foreign country. Again, goods or services does not matter. As long as it is going from India to outside, it is also exports only. Okay, next important thing, Indian employee is going abroad and he is earning abroad, like off-site, etc. They will say, no. So what will it come in, exports or imports? So clearly, so till this time you saw the good movement, especially have goods or service movement happening cross-border. But now, from these three examples, you will see that things getting very tricky. So there only you need to understand. So similarly, if you see a foreign tourist coming to India, he's spending his currency here. It is exports or imports. Essentially, entire transaction is happening within country. So it is export or import. Think about it. Similarly, Indian going for higher studies abroad, whether it's export or import. So these are the tricky examples where you need to analyze. So coming to that part, third part, Indian employee, essentially he is earning abroad. So that means what? He will be sending that money back to India, whatever foreign currency. There is an inflow of money, sir. Okay. So in this case also, if you see, the goods are going to foreign country, but the money is coming in India. So when finding exports and imports, I would always want you to think in money terms. When money comes to India, that means it is exports. Okay, so here the Indian employee working in a foreign country, it is a export, sir. Similarly, foreign tourist visiting India, that means what? Foreign tourist visits India. US person comes to India, he will spend dollar in India. So what does that mean? So essentially, if he is coming to India and spending dollar, that means what? We are getting the money in, sir. Again, this is also export. Okay. Now, Indian going for higher studies abroad, that means what? As an Indian, I am going to foreign. Okay. I am going to spend my Indian rupee, convert into dollar and spend it there. That means what? I am taking my money out of the country. The money moves outside the country. That means I am giving payment to foreign country. That means it is import, sir. So that is why I said always look for money flow. Okay, money flows into the country, export, money flows outside the country, import. So even in the first, second class also you can see money flows into the country. Here also money flows into the country. That is why it is export. So whenever in case of application part, use money. Now we have essentially completed the most important method, expenditure method. Now we will be supplementing with income method and product method. So and just fun fact is, like, all three methods will be used in some capacity for GDP calculation. We don't use one other method. Based on the information availability, we use one or the other method, and based on the area of application, okay, to get the better estimate. Ideally, all three methods should give same GDP, but because of data unavailability, that is not the reason. So with that, we'll be moving into income method. So income method I've already explained. So there's nothing much to explain. You must have already seen it in the circular flow of income, sir. Basically, if you go to circular flow of income, you will be seeing what? The upper arm. This upper arm, what? Essentially all the households are receiving income. I have already said preliminarily, you can see here. So this is the income method, I have already said. So essentially this is an income method of GDP, but taking into reality into account, we will make some modification, that's all. So what is that modification only we are going to see here. Okay, so that's why I said focus on the earlier part, because the later will be just purely adding just adapting to the changes since your core is done. Okay, so now we will see income method. We already saw this 4, we already know by heart. By now you should know what are the 4 factors of production: land, labor, capital, entrepreneurship. Land will be having rent, labor will be having wage, capital will be having interest, okay, then entrepreneur will have profit. Profit is set by pi. So these 4 we know. What is this OS and MI, sir? OS means operating surplus evident, MI means fixed income. What are those things? Why are they coming into addition? Okay, so this division is possible basically only when It is a formal sector, sir. When it is a formal sector, I will be able to divide and say, okay, this guy is the manager, this guy is the entrepreneur, this guy is the worker, and this is my mission. Let's say, example, I am running this institution, and this is my TV. Okay, I am also teaching. So I am the laborer, I am the entrepreneur, I am also capital owner. Okay, so that means entirely all things I will be getting. So essentially for this I will charge only one payment. Where will I put it? How will I divide it? So the presence of this unorganized or hybrid structures calls for, mixed income. So that means this is a result of, household industries and, managed by self-employed worker where, value added cannot be separated from labor and entrepreneur. So what is minimum value added? That means simply put, value added means what? So I have a thread, I am value adding and making it as a cloth. Okay, so value addition means you're essentially doing some processing to improve the value. You get it, right? So when that value added cannot be clearly said, so that is when we will be using this mixed income. Similarly, operating surplus also, I have given compensation to employee, okay, I have given some wage, okay, but the value added is more than that. So what is the extra value added? So the value added and compensation, that difference is called as operating surplus. Okay, so these are all, since to take into account the day-to-day realities, these terms are added. So adding this, we will be getting overall GDP by income method, sir. Next, product method, by far the most easiest method. It is already, this also we have seen. So where did we see? We already saw in the circular flow of income saying that writing in the box of the firm or business, what did we write? So essentially whatever they are producing, they will be producing some quantity and they will be selling it at some price. So that whole thing is called as product method, as simple as that. But what changes? We will look at some of the changes which we will make here. Essentially these are with respect to GDP's definition only. Okay, so one sec, yeah, are we there? Yes, finally. So GDP already said that we will be looking at only final quantity. So that means what? For all the final output only we will take, sir. That means from all the quantities produced, we will remove the intermediate consumption, that is Q minus intermediate consumption. So only we will take final quantity. And what price we will take, sir? We will take the market price. So our product of these two will be the GDP. A simple example will be a car tire, which I already explained. That means when your tire buying from directly for your, buying from shop will be a final product. Rather, if you buy a new car, their tire becomes an intermediary. So simply like that, I've already explained. So you exclude the intermediate consumption, take the final consumption, multiply price. That's all. In accounting term, this is just another definition. Just, in accounting term, they also say like sales is nothing but, price into quantity, whatever is sold. Okay. So, but what should be, which sales we should take? We should take all those things which are produced the current year. So whatever that are sold, whatever that has been produced last year will not be taken into account for this year's GDP. Rather, whatever extra has been produced, okay, there will be some extra, right, that will be taken. So essentially, actual sales happening, of which I will remove last year produced stock, I will add this year extra stock. So this is nothing but again saying how much it has been production has happened. So that is the production method, sir. So that is a production method. So with that, okay, so we conclude all three methods of GDP calculation, and then we will be moving into next basics. Okay. So we have seen, three methods of GDP calculation. Now we will be moving into, basically the formulas and, understanding of all these parameters. Essentially we have done GDP, and what did we say? GDP is nothing but market value of final goods and services, that is GDP and market price. We have derived through three methods, but we also have other parameters which need to understand in national income accounting, like gross national product, GNP, and apart from that, net domestic product, etc. So you remember the basics which we did, like gross versus net, and then domestic versus national, factor price versus market, factor cost versus market price. All those things will be applicable here. So essentially through that we will be deriving all the formulas, as simple as that. So you had the understanding. Now finally we are reaping the output out of it. So all these formulas, like 8 set of formulas, we will be deriving, and all this will be simple and easy for you. Even you don't have to mug up how many formulas, so you can just simply derive. We already have what? Gross, domestic product, market price. First convert gross to net. You have first thing, net domestic product at market price. Next, convert domestic into national. Okay, gross national product at market price. Okay, second formula. You don't have to mug up also, there also. Next, add both net and national. So this thing you add and bring. So net national product at market price. Okay. So now you have 3 formulas. All these 3 formulas you just simply write down with factor cost. So essentially you convert market price into factor cost. GDP at each, like GDP at market price becomes GDP at factor cost. Similarly, and NDP becomes NDP factor cost. Similarly, all those things you convert to factor cost. So you will get this set of formulas. So like set of formulas. So you don't have to remember also how many are there. Then and there if you want to derive. Now finally we will come to what are each formulas mean. So we already know GDP at market price. Last time we saw it is nothing but consumption, investment plus government expenditure plus X minus M, all those things. But now what is NDP at market price, sir? Okay, here it is gross, here it is net. That means what should I do? By now it should come to your mind that we have to remove depreciation. Gross to net what? We remove depreciation. That is GDP at market price minus depreciation. That will give me my net domestic product at market price. Next thing, GNP at market price. How will I get, sir? That is gross national product at market price. So differentiating factor is D, and here it is national. So that means what did I say? So you will essentially put GDP at market price. So then for national, what will you do? Basically you will add your remittance and remove your payments. This is also called as net factor income from abroad. So that's all. You simply got the second understanding. So because national means all the citizens should be covered rather than boundary. So domestic, all those things. Next thing, net national product at market price. We already have gross. So gross to net what? Simply this formula, GNP at MP minus depreciation. So that is the formula. So instead of GNP MP you can substitute. Okay, so what will you substitute? GNP MP, this entire term, GDP MP plus NFIA minus depreciation. Okay, so that will be your this formula. Next, coming to final thing. Next thing is you will be coming to GDP at factor cost. So you already have GDP at MP. How will you go to factor cost, sir? So essentially what did I say? Factor cost means at the factory gate. Okay, that means what? From this GDP at market price includes taxes. From factory gate, if I want to go from factor cost to market price, I will be adding taxes and I will be removing subsidies, because the product will essentially get the tax, like the product value will be added with the tax to get the new price. But on top of that, government will give subsidies. So essentially we'll be removing the subsidy, will be reducing the price. So we'll be removing. So if you want to come to market price to this thing, so maybe I'll write it down for the better understanding. So you can see, essentially if I have market, factor cost, from there if I want to go to market price means what will I do? I will add tax, I will remove subsidy to go to market price. So I'm sure you must be doing, doing your maths and your CSAT, etc. So this side, if one thing is plus, here it will become minus. So essentially your market price minus tax plus subsidy, that will be nothing but equal to factor cost. As simple as that. So that means what? Here I have my GDP MP. What will I do? GDP at market price. I'm not okay. I'll write it. Market price. From this, I will remove what, sir? I will be removing my tax. I will add my subsidy. So through this, I will be getting the factor cost. Similarly, for all these things, net domestic product, gross national product at factor cost, then NNP at factor cost. So for net domestic product, you take this thing, and here with this, you remove tax and add subsidy. So that will give you the final definition. So similarly, you can write for all these things. The solution, I have given it for you. So, okay. So this is a full solution. So essentially the final value, if you look, the NNP at factor cost, that is net national product at factor cost. That means you will be taking GDP factor cost. From that, if I'm going from gross to net, so that means I'll be removing my domestic depreciation. I'm going from domestic to national. That means I will be adding my next net factor income from abroad. This, even if I want to decode, that means this GDP at factor cost will be replaced by, these terms, GDP at market price, and then I will add my IDT. IDT means indirect tax. Okay, indirect tax, as of now, you can keep it as GST. Direct and indirect tax, etc. will be covered. You can keep it as indirect IDT or product tax, one and the same, but the explanation will be covered in the public finance class. So essentially, I will be subtracting the tax, adding the subsidy, and these two things will directly come. So essentially, my final formula will be this thing. Why am I explaining this thing? Because it is already asked in UPSC once. So similarly, UPSC, if it asks, they will give 4 options like this formulas. You just have to decode it and then check in which of the thing it matches. Okay. So with that, now we are finally coming to national income. So we have done GDP. Till now, what have we taken? We have taken GDP and national income are one and the same. Now only we are going to differentiate the national income from GDP, sir. Okay. So that means, what is national income, sir? Till now we have said that it is output, GDP, product, so many things. But now a clear-cut definition for national income would be, all the factor incomes. By now I don't have to explain factor incomes to you. I've repeated a lot of times. Okay. Earned by citizen within country and abroad. Okay, so that means the factor income. That means the people of our country are providing some factor, be it land, labor, etc. For that, what income they are getting, either when they are employed in India or abroad. That is called as national income, sir. That means, among all this definition, which should come, sir, for national income? So which will be the most suitable? See, I'm saying, it should be, only factor incomes. That means definitely all the market price are ruled out, because they are not having factor cost. They are having the effect of taxes and subsidies. So essentially that means we ruled out all these 4. Only these 4 are left. Next, what did I say? It is national, sir. I mean, citizens. Only citizens you will be considering. That means you rule out all the domestic. Okay, finally coming to these 2 things. Then it should be, payment to all the factors of production. That means what? Gross has depreciation. Depreciation, are you paying to any factor of production? No. Depreciation simply wear and tear. Wear and tear you are not paying. So that means our final candidate will be NNP at FC. I have literally explained why net national product at factor cost is a national income. So we will be seeing the reasons now. Okay, so this is what I've said here, and I've also explained why. So, but now formally we'll be seeing essentially why national. Obviously, it is because of citizens. Next, why net? Because we cover only factor incomes. We are not focused on any other things, depreciation and all. Why factor cost? Obviously, one reason is factor income. Other thing is, when we want to do international comparisons for national income, if we include, instead of factor cost market price, there will be effect of taxes, sir, and taxes will vary with countries. Okay, like India will have different product tax, like GST will be here 5%, 10%, USA it will be 2%. So if you take the taxes, then essentially you cannot compare what actually people are being charged with, so that you cannot get to know. So to remove such discrepancies because of government policies, we are taking factor cost. So essentially you get the reason why NNP at factor cost is the national income. Now this is the payment which they are supposed to get. Okay, now we will be seeing the other parameters. I will be coming to, okay, fine, I'll complete the per capita income. See, till now whatever parameters we have seen is at a macro level, like GDP, national income, all those things, GNP, NNP, etc. All those things we have seen at a India level. This is the only term which will be at an individual level, per capita income. The name itself says per capita income. That means for per person. That means simply you write national income and divide by population, you will get per capita income. Sir, recently India crossed 1 lakh rupees as per capita income. So that's just a fact. I'll have my water. So next thing, we already covered national income, per capita income. Now we will be looking at personal income. Okay, sir, you have already described national income as, you know, what all the factors of production receive. Then what is the difference between national income and personal income? See, personal income is what people receive in hand, sir. They receive, see, whatever is charged national income, you will not receive, but rather something else you will receive. So that means there will be some deduction and there will be some addition. So what are those things? That is what we are going to see, the difference between. So essentially, to understand personal income, you have a value called as national income. From there, something we will deduct and something we will add to arrive at personal income. So essentially, that is the income which person will see in his hand. Okay. So if you take the economy, sir, economy can be like from like a worker point of view. It can be categorized in 3 categories of people. Like there are dependents who don't work. This can be, you know, old age, children, etc. So will they be getting any income? Definitely, sir. Old age will be getting old age pension, government support. Unemployed will be getting unemployment allowance, government support. All those government support, they are getting extra, no? So extra, it is coming to their hand. That means plus. So you will be adding national income plus transfer payments. So these are people who are not working. Next will come. There are again employees, people who work will already get wage, that we already accounted for in national income. Okay. So now when the employee is there, is he going to get entire salary in his hand? No, definitely not. He will be paying what? Social security benefit or contribution. What is that? I will be paying for my PF. I will be paying for my insurance. So and so. Okay. Provident fund insurance. So that will go. So after deducting that only, I will get net remaining as a salary. So that means this social security contribution will be subtracted, sir. Next, we will come to employer. Okay. An employer, he will get some profit, no? So, but is he going to take all those? Definitely not. He has to pay what? Corporate profit tax, that I have written as CPT. So he has to pay that. Apart from that, some part of profit he will not distribute to anyone, he will not take, rather he will keep in the company itself for future investment purpose or some other purpose, that is called as undistributed profit. So essentially these two he is not going to spend. So all these things will be subtracted. Only this transfer payment is only extra coming in hand. So this will be removed and this thing will be added to get the, you know, personal income. That is an income which one can get in hand. So the formula comes down something like this. So essentially you have your national income, you are getting extra transfer payment, but you are giving, you know, social security contribution, corporate profit tax and undistributed profit. Okay. So all those, finally we are arriving at, you know, personal income. Next important thing is disposable personal income. See, I am already getting income in hand. That means all those I am spending? No. The question is, how much I am getting in hand, how much I am spending? No, definitely not. Because after I am getting in hand also, I have to pay some income tax, sir. Okay, so my salary, they will say this much you will get, but after what? Income tax reduction. So all those disposable income, from that you remove your income tax. The remaining only you will spend or save or whatever you do with it. But that is called as disposable. That is under your control. So this is disposable personal income, sir. And this essentially is nothing but consumption and savings, because what we do with either we consume or we save for the future. Okay. So with that, you know, we have covered all the all the basic terms like GDP, GDP2. We have GDP2. We have come to still disposable personal income. So all the basic parameters and derivation and formula and understanding are completed. Next, we will be moving to the next part.